Good evening, students. Welcome to the session. Today we are going to have the revision session for the topic of assessment of various entities. And in today's class, we are going to revise the entire topic. Of course, we have two classes for this. So we are going to break this topic into different segments that, we are going to talk about different entities. So with that, I'm assuming that you will have revised some basic, you have idea, because we are also going to focus on the questions with respect to the this particular topic and the different segments that we have. So I want you to be very participative about this, so that we are able to gather that how much knowledge you have. We are able to help you so that you don't end up making the mistakes in the examination. So whatever topic that you have for the revision class, you're expected to solve that and then sit for the live classes. Because these topics are going to be the revision lectures and not the full-fledged lectures. In case you have, like, you've not gone through the topic, you can go through these still full-fledged lectures where we have discussed this entire topic in detail. But these classes are just going to revise the session for you or revise the topic for you. These are just the revisionary sessions and not the full-fledged lecture, as I'm emphasizing again and again. Okay, so with that brief background, let us quickly start with it. So in the assessment of the various entities, what are the different areas or what are the different entities that I'm going to cover here is basically, so in respect of the individuals, in respect of the companies, in respect of partnership firms, AOPs, BOIs, cooperative society, and the HUF. Okay, so first we'll start with the companies. So with respect to the company, what are the type of companies that we have? Can you answer? What are the different types of companies? Yes.
Domestic and foreign companies.
Domestic and the foreign companies. Yes, Geeta, good. So, what is the difference between the two? Which companies are the domestic companies?
Indian companies.
Indian companies, right? And there is one more company which is a foreign company, which is a domestic company.
Distributes dividend in India. Foreign
No,
company, no.
no, no, no. Anybody else? Yes. Closely held company, no. Ayush, no. Poem in India, no. Yes, which company is a domestic company?
Companies which make a declaration for dividend.
Correct. So the company which has made the prescribed arrangements for the declaration and the payment of dividend in India. That is also a domestic company. Now, what are the prescribed arrangements for the declaration of the dividend? Yes. Yes.
Which makes books of books and pay dividend in India.
Sorry, can you elaborate?
Make books of accounts in which dividends are paid and annual general meeting it is held in India.
Just give me a minute. I think there's some technical glitch on your. Are you able to see the screen? आई थिंक हैंग हो गया है मेरे यहाँ जस्ट एक ही मिनट दीजिए About the domestic company, the one which has made the prescribed arrangements for the declaration and the payment of the dividend in India. Okay. Now, if you talk about the prescribed arrangement, which means it maintains the register, share register. It holds a board meeting in which the dividend is, or the general meeting in which the dividend is declared in India. And it pays in the bank account or it pays to the shareholders in India. That is the meaning of that. And if that is a company, that is considered as a domestic company. Now, what is the tax rate for a domestic company?
If it
Yes,
opts for BAA or BAB, then 15% and 22%. And for normal tax regime, it is 25% and 30%.
correct. So that is the tax rate for domestic company. What is the surcharge for the domestic company?
Up to 1 crore, no surcharge. Above 1 crore to 10 crore, 7%. And above 10 crore, 12%. And for
Correct.
this BAC and BAB, it's 10% mandatory.
Correct. What is the tax rate for the foreign company?
It's 35%.
35%. What is the surcharge?
Up to above 1 crore, up to 10 crore, 2%, and above 10 crore, 5% surcharge.
Correct. 2% and 5%. Okay. So that is the tax rate for the foreign company. Then what are the other two types of company wherein we decide the nature of the income? Like what is the scope of the total income? How do you decide the scope of the total income? Do you decide on the basis of the domestic company and foreign company? Yes. How do you decide the scope of the total income? Yes, students, faster.
It's non-resident companies, no?
Resident and non-resident company. Right? So, what is the difference between the resident and the non-resident company? Which company is a resident company? Yes.
A
Which
place
company is
of
said to be a
effective
resident?
place of
Yes.
effective management is in India.
And
Active business in India.
no. What is the meaning of resident company? Under which section do you see? Yes. Yes, students, you need to revise this. You need to be knowing this. Which company is a resident company? Section 6 talks about a company which is a resident company of India. Yes, an Indian company. What do we mean by an Indian company? Yes. What do we mean by an Indian company? Yes, students, faster. I'm not getting answers. Yes. Which company is an Indian company? Yes, Dhruvi. Yes, Anushi. What is the
Registered
meaning of, sorry?
registered in India.
Incorporated in India as per the Companies Act. Right? That is an Indian company. And that is always a resident of India. And a company which has a place of effective management in India, that is also a resident company of India. When a company is a resident company, what is its scope of total income?
Global income is
Well,
taxable in India.
Correct. But what if a company is a foreign company but is a resident company because of the place of effective management in India? Then what will be the tax rate of that company?
35%.
Why? Why not 25? Why not 30? Why not 15? Why not 22? Yes, it's a resident company now.
but still, it's a foreign company, and tax rate for foreign company is 35%.
Yes. So the tax rate for the domestic company is 25 or 22 or 15 or whatever. The tax rate for a foreign company is 35. So even though a foreign company becomes a resident company, it doesn't become a domestic company. Are we getting this point? Yes or no?
Okay.
So the resident company or a non-resident company, the distinction is important to identify what is the scope of total income. The difference between a domestic company and foreign company is important to identify the tax rate. For a non-resident company, what is the scope of total income?
Income which is
Yes,
from business in India will be taxable in their end.
not just business, income accruing or
Accrued,
arising.
all right.
Yes, income deemed to accrue or arise. Income received in India will be considered in the scope of total income. So see students, now you've got to CA final, you have to use the correct wordings in the examination. You're expected to use the as is words as are used in the Income Tax Act. No here and there, no shortcuts, no rephrasing, as is, because income tax is a law. And that's the reason why the more you will answer, the more I'll be able to correct you. So you have to keep answering so that it is for your own benefit that you will get corrected. And those who are answering, if there is a mistake identified, I will request you to please make the note of these mistakes so that you don't repeat these mistakes in the examination. Right? Then which are the other type of company? There is a closely held, there is a widely held company. What is the difference between that? What's a closely held company?
It's private companies, ma'am.
It's private company. Then what's a widely held company?
Which
Where
are
the public is interested substantially.
Sorry, what? Zubi?
Where the public is interested substantially is a widely held company.
Yes. So it is not that just a private company is a closely held company, Geeta. Right? A widely held company is basically a company in which public are substantially interested. It can be government, it can be RBI owned company, a non-profit organization, Section 11 companies, right? Nidhi mutual benefit companies. Then a public limited company or a subsidiary of a public limited company. So a listed company which is there is a widely held company, and a subsidiary, unlisted public limited company, a subsidiary which is unlisted public company of a listed company is also a widely held company. So what is a closely held company? A company in which public is not substantially interested, which will be a private company or even an unlisted public company which is not a subsidiary of the closely held of the listed company. Now, why is this difference between the two important? Why do you want to see whether it's a company in which public is substantially interested or not interested? Why is this distinction important?
yes, ma'am. Section 222E. I think it is for public. dividend and
Yes, there are many sections which are applicable only to the closely held company. Which are the other section?
section 68 credit, cash credit.
Cash credit, yes. Section 79. Right? Section 56. Right? There are many sections which are only applicable to closely held company, which are more in the nature of anti-avoidance rule. So is the distinction between different type of companies clear? Yes.
Yes, ma'am.
Now moving on to the taxation, we discussed what are the tax rates. Now, one very important topic you might have, looked at the tax rate, section 115 BAA, BAB, when, you need to opt for it, what are the conditions. So I'm not going into that in detail, but we will have a kind of recap of this very quickly. The difference between the 115 BAA and BAB. Okay, so what is section 115 BAA? To which company it is applicable?
Except this manufacturing and electricity generating companies, all are included in it.
Correct. Any domestic company other than the manufacturing or electricity generation. For manufacturing and electricity generation, we have 115 BAB. What is the rate of tax under 115 BAA? You discussed it's 22% plus 10% surcharge plus 4% cess, making to effectively 25.168%. Under 115 BAB, we discussed it is 15% plus 10% surcharge plus cess of 4, making to 17.16% effective. Right? Now, what is a domestic manufacturing company? What are covered in the manufacturing? Yes. There are certain exclusions which are given in 115 BAB. What does manufacturing does not include? Mining, yes, Samyathan. Yes.
Mining for software, computers.
Development of computer software, mining,
Printing.
yes. Printing of books, yes. Bottling of gas into cylinder, yes, Samyathan. Conversion of marble blocks, cinematographic film production, these are not covered under manufacturing. Right? Computer software, Samyathan, the development, yes. So, this particular 115 BAB company, what are the conditions for it? To avail this rate, what is the condition?
Certain deduction or exemptions not allowed under section 10 AA, 35 AD, and 32 additional depreciation will be not allowed.
Yes. What are the other conditions?
These companies should be set up on or after 1st October 2019, but before 31st March 2024.
Yes. Very good. So these companies should be set up and registered on or after 1/10/2019. And they should commence the manufacturing or production or the generation of electricity before 31st March 2024. So right now, if a company is established, they can't claim 115 BAB. Right? Then what are the other conditions?
MAT provision is not applicable to it.
MAT is not applicable, but what are the conditions?
Plant and machinery should be new, but exception is there. 20% can be the second-hand plant and machinery, and secondly, important plant and machinery will be treated as new only.
Good. Yes. So it should not use any second-hand plant and machinery. But in exam, don't use the word second-hand. Okay? In exam, you need to use the word, it does not use any plant and machinery previously used for any purposes. However, there's an exception to it. What is the exception to it? The exception
Imported.
is, yes, that if the plant and machinery which is there was not used in India and is imported into from outside India, that can be used, or the value of the plant and machinery which has been previously used is not exceeding 20% of the total value of the plant and machinery used by the company. Are we clear? Then what are the other conditions?
Chapter 6A deduction except 80 double JAA and ATM.
Yes.
35 CCC, 35 CCD, 32 2A, AA.
Yes.
Scientific research.
Yes. What are the other conditions?
Not formed by splitting up or
Good.
reconstruction of existing business.
Yes, very good. It should not be formed by the splitting up or the reconstruction of the existing business. Right? It should not be engaged in any business other than the business of the manufacturing or production or research and distribution. It should not be engaged in any business other than manufacturing. Are we clear? So these conditions, what we discussed, are not applicable for 115BAA. These are only for 115BAB. The conditions for not claiming certain exemptions and deductions are applicable for both the sections. For example, exemption of SEZ 10AA, additional depreciation you can't claim. You cannot claim 33AB for tea, coffee, rubber development. Right? Site restoration. You cannot claim the scientific research expenses. But with scientific research expenses, we can claim
In-house.
yes, in-house we can claim. Very good. Then we cannot claim any expenses of scientific research paid to outsiders. Right? For national laboratory, to any research association, that we cannot. Chapter 6A deductions other than 80 double JAA and ATM. What is 80 double JAA?
New employees.
Correct. Deduction for the hiring new employees. What is ATM?
Is dividend given and dividend received by the company.
Correct. Set off of the dividend. ATLA for unit in IFSC can also be claimed. Right? Then if you want to opt for 115BAB, right? You have to do it in the first year of incorporation, before you file your first income tax return. Yes or no? And when you claim 115BAB, you have this 17% tax rate. But what about any other income? Any other income which is there, what will be the tax of that?
22%.
So it is not directly 22, I'll tell you. In case of the income which is covered under any specialized tax rate or specific section. So any income which is subject to tax in any specific section, for example, LTCG, STCG, that would be taxed under that section itself. But what will be the surcharge?
10%.
Correct, 10%. The surcharge would continue to be 10%, irrespective of the limit of that income or the quantum of that income. In case of any income for which no rate of tax is specified, in case of any income for which no tax rate is specified, then it will be taxed at 22% plus 10% surcharge. if there is an income which is incidental to manufacturing or production, that will be taxed at 17% itself. Right? In case of a short-term capital gain, okay, one more thing. In case of the any other income, which is for which there is no specific tax rate, it will be taxed at 25.168%. But you will not get any deduction or allowance of any expenditure. In case of short-term capital gain, which is not a depreciable asset and which is not chargeable under 111, the tax will be 25.168%, but you can claim the deduction of the cost. Are we clear? Yes or no?
Yes, ma'am.
Okay.
Yes.
What if you fail to fulfill the conditions of 115 BAB? What if you fail to fulfill any condition? Yes. What happens when you fail to fulfill the conditions?
At 30% will be charged.
30%? No. If you fail to satisfy the conditions, for example, if you if you purchase second-hand plant and machinery, or you claim some deductions which are not allowed to be claimed, or you engaged in any activity other than manufacturing, then this 115 BAB itself will become invalid. And you can still claim but 115 BAA. So if you fail to satisfy 115 BAB, you can still claim 115 BAA. Are we clear? And plus, there will be transfer pricing which will be applicable in case of any transaction between a 115 BAP company and the other company. And the income in that case will be taxed at 30% plus 10% surcharge plus 4% cess. In case of 115 BAA, if you fail to fulfill the conditions, then in that particular case, you will be continued to be governed by the normal provisions. Are we clear? Can you once exercise the option under 115 BAA and come out of it?
No, ma'am.
Yes or no?
No, ma'am.
Only once. So, when you claim the option, unlike in the case of 115 BAB, where you have to exercise the option in the first year itself, under 115 BAA, you can exercise the option at any time before the due date of filing the return of income under 139 month. You cannot exercise the option in the belated return. Once you exercise the option, it will apply to all the subsequent years and it cannot be subsequently withdrawn, even for 115 BA. And the option, if it is withdrawn, right, the option, can be exercised, but it cannot be withdrawn subsequently. So it is not that you can withdraw. Once you exercise this option, you have to continue to be governed by this particular provision. You cannot come out of it. That is under 115 BAC that you can come out of it for once. Under 115 BAA or BAB, you cannot come out of this option. Are we clear, students? Yes? Everyone?
Yes, ma'am.
Yes, ma'am.
Okay. Now, For a company which is exercising 115 BAA or 115 BAB, the MAT is not applicable. Minimum alternate taxes are not applicable. Okay. So for a company which is exercising the 115 BAA or BAB, minimum alternate tax is not applicable. So minimum alternate taxes are applicable to whom? It is applicable to a domestic company and foreign company both. It is applicable to both domestic company also and a foreign company also. But what are the exclusions? A company exercising 115 BA or BAB, life insurance corporation, a company which opts for tonnage tax scheme. We'll see that later. If it's a foreign company, what are the exclusions? A foreign company opting for presumptive tax. Foreign company is a resident of a country with which India has a DTAA and does not have a permanent establishment in India. A foreign company is a resident of country with which India does not have DTAA, but it is not required to register under the Companies Act. What is the rate of MAT? Yes,
15%.
15%, right? So if tax on the total income is less than 15% of the book profits, then book profits shall be deemed to be the total income. If the tax on the total income is less than 15% of the book profits, then book profits shall be deemed to be the total income. And in that particular case, all the provisions of the total income will continue to apply to the book profits, which is you will have to pay advance taxes. If you have not paid, then your interest will be applicable under 234B, 234C. Clear? Okay. In the case of MAT also, since your book profits are now deemed to be total income, you will also end up paying the surcharge and cess as well. So what will be my surcharge? Yes.
Same as Indian companies.
Same as the domestic company in case the MAT is applicable on domestic company, and in case it's on foreign company, same as to the foreign company. Now, how do we compute the book profit? What is the starting point for book profit? Yes. How do you start the computation of the book profit?
Book profit as per books of accounts.
No, it is the net profit as per the P&L account prepared in accordance with the Schedule 3. And then you make certain adjustments as per the explanation 1 to section 115 JB. Okay, so this minimum alternate tax is applicable when your total income tax is less than 15% of the book profit. The book profit which are there is going to be as per the profit and loss account as increased or decreased by certain adjustments. Now, what are the adjustments? When it comes to the income taxes, you will have to add back any provision for income tax. You will have to add back any income tax, surcharges, cess, interest on income tax. What about the penalties on income tax? Whether you will add your for the purpose of computing the book profit?
Oh, ma'am, penalties are not included.
Penalties are not included. So even though under the normal profits, you disallow the penalties under section 37. Yes or no? But here, you will still allow it because you can only make the specified adjustments. That's it. Are we clear? Yes or no? Then you have to add the deferred taxes, right? Any deferred tax that you have created minus deferred tax credit, which has been credited. Then amount transferred to the reserves. Any amount transferred to the reserves, if it's debited, you need to add back. If it is withdrawn and credited, you need to reduce. Provision other than for ascertained liabilities. What do you mean by provision other than for ascertained liabilities? Yes. Yes, what do you mean by provision other than for certain liabilities? Yes, students, faster. What do we mean by the provision other than for a certain liabilities? Yes.
Means certain liabilities are not included.
But what are certain liabilities? What do you mean by certain liabilities? Can someone give the example? A certain liabilities are which can be determined, right? So you have to here just add the provision if it is for unascertain liabilities, right? If it is debited or if the amount is withdrawn, then you need to credit. So for example, provision for any unascertain liabilities will include kind of provision for gratuities if they are not based on some actuarial valuation. If there are some provision for losses that are created which are not based on some calculation scientific basis, right? That is uncertain liability. What do we mean by a certain liability? If there are warranty provision which are created, right, which are based on some past claims, gratuity, if it is based on actuarial valuation, that's an ascertain liability. So that I will not add back. Only the provision other than for ascertain liability. What are the other provisions that we need to add back? Provision for the loss of subsidiary company. We need to add back. Transfer to the revaluation reserves. So any amount transferred to revaluation reserves minus any amount withdrawn from the revaluation reserve. Provision for diminution in the value of asset. Let's say, for example, if I have the bad debts, provision for bad debts, not actual bad debts, provision for bad debts, I will disallow. Provision for reduction in the value of investment, I will add it. Right? Provision for diminution in value of any asset. Provision for income taxes, add it back. Dividend paid or proposed, add back. Depreciation. So what you need to do is first you need to add back the depreciation as per books of accounts, including the depreciation on the revalued asset. You will reduce the depreciation as per books of accounts only, not as per Income Tax Act. But you will exclude the depreciation on revalued assets. So in effect, what I'm trying to do is I'm just adding back the depreciation on revalued asset. Add income exempt under 10, 11, 12. Add expenses in relation to income exempt under 10, 11, 12 and reduce the income exempt under 10, 11, 12. Notional gain or loss on the transfer of share of the special purpose vehicle in exchange of units of business trust, or notional loss due to change in the carrying value of units. You need to add the loss, you need to reduce the gain. Can somebody explain me this? We are going to do this in the business trust topic. But if somebody knows this, can you explain this? What is the effect of this 10th adjustment that we are trying to discuss here? Yes. What is the effect of this? No one? So let me explain what happens. Okay. So let's say, for example, this is a business trust, REIT or InvIT, right? Now, what happens is to form a REIT or InvIT, it's a trust, real estate investment trust, right? To form that trust, it has to be formed through a holding company, which is called as a special purpose vehicle. Why I'm calling it as a special purpose vehicle? Because the purpose of that holding company is to just hold the investments in REIT. Correct? So we're just saying it's a special purpose. It's for a special purpose. Vehicle is just saying that it's an entity. Now when a company will be formed, there will be some shareholders of that company. Yes or no? Correct? Yes or no?
Yes, ma'am.
Right? So what happens is, I'll tell you, there may be some shareholders of that company. Now that company cannot directly do business in the immovable property and get listed because there are SEBI regulations around it. So it has to be done through the REIT structure. So what they will do is, they will first basically sell the shares of the company, right? So the shareholders of the company, the promoters of the company, this special purpose vehicle, SPV is a company, the shareholders of this company will give the shares, sell the shares to who? To the REIT, right? To the real estate investment trust. And what will the REIT do then? REIT will not pay them money. REIT will give them the units of the REIT. Okay? So I'm a shareholder of a company. To form a REIT, I will give the shares of my SPV, and REIT will give the units of REIT to me. Okay? And that way, REIT will then make an investment in the SPV. So this transfer of shares of the SPV in consideration for the units of REIT, the gain or loss which is happening on this, right? If this shareholder is a company, the shareholders are also company, not individuals. If the shareholders are also company, the shareholders of SPV is also a company, some holding company is there. It will have to prepare the P&L as per Schedule 3. It will be liable to MAT also. Yes or no? So if this shareholder are a company, they will be required to pay the MAT. Now in the net profit as per P&L, there will be notional gain or loss which will be included on the exchange of shares for units of business trust, because they have not actually sold the shares. They have just exchanged the shares for the units of the. So there will be a notional gain or loss. The actual gain or loss will arise when? When they sell the units of the REIT. Yes or no?
Yes, ma'am.
Correct. So this is what the adjustment is trying to say. If there is notional gain or loss credited to the P&L of the shareholders of the SPV because of the exchange of shares for the units of business trust, that notional gain will be reduced and loss will be added. And when you actually sell the units of the REIT, there will be actual gain or loss. That we will add and reduce from the P&L. Are we clear about this effect of the adjustment? Yes or no? Everyone, yes?
Yes, yes, ma'am.
Okay. Next is share of the member in the AOP or BOI where no tax is payable under section 86. Again, we will see that in the next class. when we talk about the AOP BOI. So since the income is exempt in the hands of the member of AOP or BOI, you will less the income and add the expenses back. Income of a foreign company. I said foreign company is also liable to MAT. If the income of the foreign company is interest, royalties, FTS, dividend, capital gain on securities, where the tax is under section 115A or under DTL, but the rate of tax is less than 15%, you will exclude that and add back any expense. Brought forward losses and unabsorbed depreciation. Now, in case of a company, you will get lower of UAD or the business loss. If UAD or business loss is zero, you will not get any allowance. In case of a company which has gone for insolvency proceedings and their application has been admitted, you will get the aggregate of the business loss and the unabsorbed depreciation. Then income in respect of royalty chargeable under 115 BBF. What is section 115 BBF, students? Yes, what is 115 BBF? Yes. Income by way of royalty from the, yes, Samnithan? Yes, very good, Samnithan. From the patents registered and developed in India. Now that income is charged to tax at the rate of 10%. So therefore, in that situation, since it is chargeable to a lower rate, therefore, in that particular situation, that income has been excluded from the MAT purposes. Are we clear? Okay. Is this clear, students? Shall we solve one question? Yes, from the module on the MAT.
Yes, ma'am.
Okay. Let us solve the question from the module. So that will give you a practice as well. Yes. Sona Limited, a resident company, earned the profits of 15 lakh after the debit of credit or credit of the following items to the statement of P&L for the year ended 31st March 26. Item debited to the statement of P&L, provision for the loss of subsidiary, 70,000. What would you do?
Add back, ma'am.
Add back? Yes. Very good. Provision for doubtful debts.
Add back.
Add back.
Add back. Why we will add back? What is the reason?
It is provision, not actual doubtful debts.
Yes, can anyone tell me the reason I just now mentioned?
These are uncertain liabilities.
Sorry, these are what? Uncertain. No. No. Yes. I just now discussed. This is provision for, yes, Samyathan, very good. Diminution in the value of the asset. This is provision for diminution in the value of asset. The value of asset is decreasing because of this provision. Which asset? Sundry debtors. So that is the reason why I am adding it. You have to mention this in the examination, students. If you look at it, they have seen mention like provision for doubtful debts being the amount set aside as provision for diminution in the value of any asset. Are we clear? Then provision for income tax.
Add back.
Add back, very simple provision for income tax. Provision for gratuity based on actuarial valuation.
It is actual valuation, so we didn't want to add it.
Yes.
No effect, ma'am.
No effect. Why?
It's determined, so actuarial valuation, so ma'am.
It is an
Yes.
accident liability.
Yes, very good. This is an ascertained liability because this is based on the actuarial valuation. So if you look at the answer here, it says in the notes you have to mention provision for gratuity based on actuarial valuation is an ascertained liability, hence the same should not be added back to compute the profit. What would happen if you were computing the normal tax liability and not MAT? Would you add this? Would you add provision for gratuity for normal tax? Yes or no? Samnathan, under which provision you would add back? Yes. Under which provision we will add back? As allowed on payment only? No. 115 JB is for MAT. I'm asking about normal provision. Dhruvi, yes, it is allowed on only payment basis, but there's a specific provision, section 40A7, which says that provision for gratuity will not be allowed under the normal income tax computation. You will get only when you make the payment under 43B. Yes. So, if you are computing under normal provision, you will add back provision for gratuity, but under MAT, if it is based on actuarial valuation, it's an ascertained liability and you will not add back. Okay. What about the depreciation? Add back, yes. Interest to the financial institution unpaid before the filing of the return.
No effect, ma'am. It is not mentioned in MAT.
Correct. If it was normal income tax provision, then
We have to add back.
as per section 43. Fine. Penalty for infraction of law.
No effect, ma'am. Penalty or
No
not.
effect. Yes. If it's normal, you will add back in section 37. Items credited to the P&L. Profit from units established in SEZ. Yes.
No effect, ma'am.
No effect, right? Because only the income exempt under 10 and 11 are excluded. This is the exempt under section 10 AA. Right? So here it will not be exempt. Share in an income of an AOP as a member. 1 lakh. Here it is mentioned the AOP of which the company is a member has paid the tax at the maximum marginal rate. Yes?
Deducted, ma'am. It reduced.
Sorry?
It is reduced, ma'am. 1 lakh.
It is reduced, right? Because if the AOP has paid the tax at MMR, the income becomes exempt in the hands of the member under 86. And we just now saw that if it's an exempt in the hands of the member under 86, you need to exclude this. Income from units of Unit Trust of India.
It's not deducted. It is not mentioned in that.
It's not deducted because income from units of UTI is taxable. The same will not be reduced. It's not an exempt income under 10. Long-term capital gain on sale of building.
Is also not reduced, ma'am.
Correct. Depreciation includes 1,50,000 on account of revaluation of fixed assets. So what will you do? Your depreciation was 3,60,000.
From 3,60,000, we have to deduct this 1,50,000 and balance we have to take, reduce it.
Correct. So you will reduce 360 minus 150, which is 210. Right? So in effect, we are adding back the revaluation depreciation. Depreciation as per income tax rule is 2,80,000. This is of no use. Brought forward loss of the, as per the books of accounts, is 10 lakh, which includes the unabsorbed depreciation of 4 lakhs.
We have to take 4 lakhs, ma'am, whichever is lower.
Correct. Provision for income tax includes 45,000 of interest payable on income tax. We have considered the provision for income tax here.
We have
1
taken
lakh
in
five.
it.
Sorry?
We have taken in it, no? So we
Yes. So 45,000 will not be excluded. Clear? So you'll get 14 lakh as a book profit. You will add 15% and do not forget to add education cess. Your surcharge is not applicable. So we have not added that. Is this question clear to everyone? Yes or no?
yes, ma'am.
Yes, everybody. Shall we solve one more question on math? Yes.
Yes, ma'am.
Okay. So let's take one more question. This is a question. 1 second. Let me reshare the screen. Is the question visible?
Yes, ma'am.
Okay. ABC Private Limited incorporated on 1/11/2025 is engaged in manufacturing of footwear and has set up factory in Northeast. It has reported a net profit of rupees 80 lakh for the previous year 25-26. Following items have been credited or debited to P&L. But what we are supposed to do over here, we are supposed to not only compute the normal taxes. If the question in the exam does not ask you that or just tells you that compute the total income and the tax liability, if the question in exam doesn't tell you to ignore the provisions of 115GB, 115BAA, 115BAB, that means you have to consider all of these provisions. So if the exam question specifically tells you to ignore the MAT, then only you don't consider. But if it's a question of computing the tax liability, you have to ensure that you also consider the MAT. You also consider the 115 BAA or BAB as well. So here the question is asking you to do all of it, even if it's not specifically saying, but since it's not asking you to ignore, means you need to take that into consideration. So here the strategy of the question will be that you have to first compute the tax as per 115 BAA or BAB, whatever is applicable. You have to compute the tax as per the normal tax. Right? You have to compute the tax as per the MAT also. If you go for 115 BA or BAB, MAT is not applicable. So first you need to see whether the tax under the MAT is applicable or the normal tax is applicable. If normal tax is lesser than 15% of book profit, then MAT will be applicable. And you need to compare it with 115 BA or BAB to advise the assessee what is better for him. Should he opt for 115 BA or BAB or should he go for normal tax provision? If he goes for normal, the MAT will also be applicable. Are you getting this particular point, students? Yes or no? Is this question clear?
Yes, ma'am.
So basically what you need to see here is if the question doesn't ask you to ignore, then in that particular case you have to consider all of these aspects. Okay? Let's start with then the question. Here this should be 1/11/24. Okay. So following items have been credited or debited to the P&L. Contribution towards the research association eligible for deduction under 35(1)(2) for rupees 2 lakh. So what I'm going to do is, I'm going to here prepare my 3 computations. One is, let me add a table here. This is computation as per the provisions of section 115 BAA or 115 BAB. Then I'll see computation as per the normal tax provisions. And then I'll do computation as per the MAT or 115G. Okay? So let us start. Contribution towards the research association eligible for deduction under 35(1)(2) for rupees 2 lakh. So what will happen under first of all, whether you can opt for 115 BAA or BAB, which provision you think you can opt for?
BAA.
BAA. Why not BAB?
Because till 31st, 31st March 2024 it is there. After that,
Correct. So we cannot opt for 115 BAB. Correct? As the company is incorporated after 31st March 2024. Fine? Okay. So what will be the impact on the 115 BAA for this? Will you allow this deduction or will you disallow?
disallow, add back.
Add back. So I'll start with my net profit of 80 lakh. Okay. This is going to be rupees 80 lakhs. Okay. I will add the contribution to the research association because this is paid to the outsiders. 2 lakh. Okay. Then what about the contribution towards research association and the normal tax provision? Will you allow?
In fact, ma'am, it is allowed.
This is allowed? Yes. So here, this will be no effect. Okay. Fine. Then what about in the MAT?
It's allowed, ma'am.
It's allowed, so no effect. Okay. Expense towards in-house R&D of 2 lakh. Whether this is allowed under 115 BAA?
Yes, ma'am. In all the three, it is allowed.
It's allowed under all the three, right? So here you will have no effect, right? And the same goes here as well. And the same even here. Okay. Then you have depreciation as per books of accounts, rupees 40 lakh. What will happen?
Only in MAT it is allowed and others it is allowed.
In everything it will be disallowed, right? It's as per books of accounts.
Yes, income tax, yes.
Here, depreciation as per books of accounts, rupees 40 lakhs. Right? Even in the normal tax, this will be disallowed. In MAT, this will be disallowed. Okay? Royalty received from patents developed and registered in India, 10 lakh. Expenses on royalty, 1 lakh. So what will happen under 115 BAA? What will you do? Yes.
It's no effect because it is not mentioned in the provision, ma'am.
So royalty on which the patents are developed and registered in India, this is taxable separately under section 115 BBF. And as I told you, if an income is chargeable under a specific section, it will be continued to be charged at that rate and not the higher rate of 115 BW. So here I will reduce rupees 10 lakhs because I will charge it to special rate. And I will add the expenses on royalty rupees 1 lakh. So what I will do is I will consider it separately. Okay. So let me just create here boxes and I will consider it separately. On the gross basis, this will be taxable, meaning no expenses will be allowed at the rate of 10%. What about in the normal tax provision? Same thing. I will consider it separately itself. Okay. What happens under MAT? What happens under MAT? Will you add back in the reduce under the MAT also? Yes. We just now discussed, right? Royalties on the patents which is chargeable under 115 BBF will be excluded from MAT. We discussed just now, yes or no?
Yes, ma'am.
Yes. Okay, so we will exclude it. STCG on transfer of listed equity shares on the recognized stock exchange 10 lakh. What would you do? Under 115 BAA.
Special rates income, so separately taken.
Correct. So we will reduce this and consider, and plus this will be chargeable under the head capital gain. So we will consider this separately. Fine. Same goes here also under the normal tax provision as well. Yes or no?
Yes, ma'am.
Okay. Everybody, is it understanding? Is this clear? What happens under the MAT?
No effect.
No effect, right? Fine. Next, other information. Asset acquired and installed during the previous year. Plant and machinery 1 crore. 20 lakhs paid in cash. Building 50 lakh. What is the, yes, what is the impact of this information? Why is this information given?
Because depreciation we have to take on that.
Correct. Because of the depreciation. So let's calculate the depreciation. And this depreciation will be applicable under the normal tax as well as under 115 BAA also. So calculation of the depreciation as per the income tax. So what are the two assets that they have told us?
Plant and machinery and building.
So I'll make 3 columns: asset, plant and machinery, and building. Okay. So what is the cost for plant and machinery? They have told us 1 CR. 20 lakh is paid in cash. What we need to do with it?
Disallowed because about 10,000 cash payment not allowed.
Not disallow. Here we will reduce from the cost of asset. Asset purchased in cash greater than rupees 10,000. Which section is this? 43(1). So reduce 20 lakhs. Okay. So my actual cost will be 80 lakhs. What about building? What is my cost? 50 lakh. Okay. What is the rate of depreciation on plant and machinery?
15%. 10%.
Building, number of days put to use. Is there any information given?
No.
There is no information given. So we are assuming for right. So what will be my depreciation on plant and machinery?
$12 lakhs.
On building,
5 lakhs.
that's it.
Additional depreciation will be allowed in normal provision and 115 BAA will not allowed.
Correct. So there will be additional depreciation because it's a manufacturing concern. What will be the additional depreciation rate?
20%.
Whether it is allowed on building?
On building
Yes.
it is not allowed.
Not allowed. So what is my additional depreciation?
16 lakhs.
Okay. So now under 115 BAA, I will only allow normal depreciation, which was coming to 12 plus 5, which is how much? 17 lakhs. I will allow this even under normal tax provision, but I will also allow additional depreciation. Okay. What about 115 JB? What will be my depreciation?
40 lakhs.
Same as book profit because there is no depreciation on revalued asset. Clear? Next adjustment is the company has employed new employee to whom salary paid was debited to the P&L, details of which are here under. So this is the date of employment, number of employees, salary per month and per employee. The employee is hired on 25/11/2025. Two employees, 18,000 by account paid check. Yes. Whether you will get the deduction?
151 days will come. It is a footwear manufacturing, so it is allowed 30%.
You will get 30%, right? So let us calculate the deduction under 80JJAA. Will you get under 115 BAA?
Yes, ma'am.
Yes. So first is for 18,000 into how many employees? This is per employee, right? And here you will consider 150 days because this is into the manufacturing of footwear. Okay, so this is for more than 150 days. Right? So this is 2 employees and for how many months?
5 months, ma'am.
For 5 months. Okay. So what does it come to? Into, we'll see 30% for the other employees. 25,000 by ECS for employees in December 2025.
Not allowed, ma'am.
This is not allowed because
Less than 150 days.
less than 150 days. And This is less than 150. What about 111, 2025, 28,000 by check, one employee?
Not allowed because more than 25,000, and also it is in check because more specified we have to give.
We don't know it's an account pay check or bearer check, but it is more than 25,000. Okay. One 2025, 25 employees, 11,000 in cash.
Not allowed, it is in cash.
This is in cash, so not allowed. Will there be any other implication for this?
Section 43, above 10,000 cash.
Correct. So here there will be disallowance of the expenditure, which will also be under 115 DAA. Greater than 10,000 under section 40A3. What we will disallow is 11,000 into 25 employees into how many months? 5 months. Right? So what is the disallowance? What is the disallowance?
13,75,000.
Okay. So my deduction here will be only this much. What is the deduction under 80JJAA coming to?
$54,000.
54,000. This deduction will be also allowed under normal tax provision, right? So I will allow it here. And plus, we will add back the expenses under the normal tax provision also, disallowed in cash, 13.75 lakh. Whether we will disallow this under the MAT also? Yes? Whether you will disallow under MAT?
No, ma'am, it is not mentioned in provision.
Yes, so not applicable. Whether you will get deduction under MAT? The answer is now. What will be my normal tax rate? Here it is given. The turnover of previous year 24-25 was 700 crore. Is this relevant? Is turnover of previous year 24-25 relevant?
Twenty-three, 24 we want. So it is 25% tax rates.
But company is incorporated in 24, right? So for the 25% tax rate, which year you will see the turnover? Yes.
23-24's turnover we have to see.
We will see for 23-24 and not 24-25. In 23-24, was the turnover of the company more than rupees 400 crore?
400 crore. No, ma'am.
No, right?
Yes.
So then what will be my tax rate here?
25%.
25%. So here you can write down turnover of company for previous year 23-24 was 0 as company was not incorporated. Therefore, the tax rate of 25% is applicable. Okay. So first we'll compute tax under section 115 BAA, which is at the rate of 22%. What will be my tax? Total income first. Yes. What is my total income? Yes. What is my total income? Our students. Is it coming to 119.21? Yes. Yes or no?
No, ma'am. So royalty and STCG we don't
For
have.
total income, you have to add.
Okay, okay.
It is a total income only. Though considered separately, it's a total income. So my tax will come to 21.83 lakhs under 115 BAA. Then tax on royalties under section 115 BBF at the rate of 10% will be 1 lakh. Then tax on STCG at the rate of 10%, sorry, at the rate of 15%, right? What is the tax rate of STCG? Sorry,
Yes, 20%, ma'am.
20%, correct? Yes. It will be 2 lakhs. Will surcharge be applicable? Yes. Here the surcharge is not on the income, but directly 10%. Yes or no? On all the income, the surcharge will be applicable. So surcharge and then cess will give me total tax of 28.40 lakhs. Is everybody getting this answer? Yes? Yes or no? Is everybody getting this answer or not? What is my total income coming over here? 101.21 lakhs. Tax at the rate of 25%. $20.30 lakhs. Tax on royalties and STCG will remain the same year also. Surcharge at the rate of here. What will be my surcharge? What will be my surcharge?
7%, ma'am.
7%, correct? And cess of 4%. So what it will be? Total tax of 25.93 lakhs. Then here we will have MAT at the rate of 15%, right? What is my book profit? Which 81 lakh. Will there be surcharge on 81 lakh? Yes or no? Will there be surcharge?
No, ma'am.
No surcharge, right? So this is not applicable. So I will only have cess, which comes to 12.636. Now I have a tax liability of 25.93, MAT of 12.636. So I will pay the tax as per normal tax. Now I will compare this with the tax under 115 BAA. Which is better? Paying the tax as per normal tax. Are we clear? Yes or no? Okay.
Yes, ma'am.
So with this, let's take a break of 10 minutes and then we start back again. MAT provision is relating to the allowance of the or the MAT provisions with respect to the Ind AS compliant companies. Right? So as you may be aware that for the Ind AS compliant companies, we need to have the different set of adjustments, right, in respect of the Ind AS. So the MAT also provides for different additional adjustments with respect to the Ind AS compliant company. Now, what are the adjustments? So there are certain, beyond these normal adjustments, there are certain additional adjustments to book profit for companies complying with Ind AS. First is with respect to the items that form part of the other comprehensive income that shall never be reclassified to P&L. What is OCI? What is OCI, students? Yes, what is OCI? Yes, what is OCI, Pastor? You have learned in accounts. Yes, what are other comprehensive income? What is it? I need the answer, students. What is OCI? It's very simple. No one? In accounts, you have learned this or not? Or are you hearing this term for the first time? Yes. At least tell me something, students. See, students, if you will not answer, how will I come to know what you know about, what you don't know, since these are revisionary classes and not the full-fledged lecture. Yes, other comprehensive income. It includes the items that are not forming part of the P&L. It is divided into two parts. The items that will be reclassified to P&L and the items that will never be reclassified to P&L. What are the items that will never be reclassified to P&L? Are the ones which are taken into the reserves, usually, and they will be put into the OCI. Now, here the adjustment is to be required for certain items that are forming part of the OCI that will never be reclassified to P&L because there could be, to avoid the tax liability, people may be or companies may be trying to shift from P&L to the OCI items that will not form part of the P&L. Your adjustment is not required for the OCI that will sometime be reclassified to P&L. So if eventually it will get reclassified to P&L, then that year, any which ways, it will be included as a part of book profit. Yes or no? So here the adjustment has to be made for the items that form part of OCI that shall never be reclassified to P&L. No adjustment for the amounts under OCI that shall be reclassified to P&L at the end. Is this distinction clear to everyone? Any questions so far? Yes? Yes or no?
Yes, ma'am.
Okay. So any credits you will add, any debits you will reduce. You will not make the adjustments for the amounts which are relating to the revaluation surplus for asset. Why we will not make the adjustment for this revaluation surplus? Yes. Yes, students, please answer. Because revaluation surplus any which ways, it's a notional. Yes, Dhruvi, very good. So we don't want to take it to the P&L because it is a notional thing. So even if it is forming part of the OCI, that will not be reclassified to P&L. I don't want to take it into the book profit because this is a notional thing. Same with respect to the gain or loss from investments in equity instruments designated at fair value. Again, this is notional. So in the Ind AS, we need to identify the gain or loss by recasting the investments, and that will be included in the book profit at the time of disposal of the investment. So the actual gain or loss we will record it. So today this is a notional loss. I will not record it. Any assets which are in the nature of having any notional losses or gains we will not include it. We will include it in the year when the assets or investments are actually transferred. At that time, we will recognize the actual gain or loss. Second adjustment is for the demerger. So in the hands of the shareholder, when the demerger happens in the company, he gets the certain shares of the resulting company. Right? He gets the shares of the resulting company. So when he gets the shares of the resulting company, right? So any amount debited to the P&L or any amount credited to the P&L, which is basically the difference between the book value minus fair value, that will be added or reduced because again, this was notional. Are we clear? So when the demerger happens, right? When the demerger happens, at that point in time, the shareholder will get the assets, or will get the shares of the resulting company. So in the case of a resulting company also, the property or the assets or the liabilities are recorded at a value different from the books of accounts of the demerged company. And that notional gain or loss will be ignored in the hands of the resulting company as well. Are we clear about this? Yes or no? And the third adjustment which is required for the Ind AS compliant company is in respect of the transition amount. So when a company first time adopts for the Ind AS, in the previous year, it would have complied with the AS. Now, this is, let's say, the first year of the company for Ind AS. It will have to recast its last year figures as per Ind AS to make a comparative financial statement. So, obviously, there will be some amount recorded as a transition amount. So, 1/5 of the transition amount for the period of 5 years from the year of convergence have to be added or reduced. So what is the transition amount? Amounts appearing in the other equity, excluding the capital reserves and security premium on account of transition from AS to Ind AS. You have to exclude the amounts which are in the category of OCI that shall be reclassified to P&L. Revaluation surplus, notional gain or loss on investments designated at fair value, notional gain or loss on plant property, equipment and intangibles designated at fair value, notional gain or loss relating to the investment in subsidiary, JVs or associates recorded at fair value, differences relating to the translation difference of foreign operation, all these notional amounts you have to exclude from the transition amount. Are we clear? Should we solve one question here to understand this in detail? Okay. So let us solve a question. ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu, started adopting Ind AS with effect from 1/4/2022. Following particulars are furnished for 31st March 26. Book profits after adjustments of all items specified under 115JB amounted to 52.26 lakh, except for adjustment of the brought forward losses for the year ended 31st March 2026. Brought forward losses as per books of accounts, rupees in lakh, is given. Financial year 21-22 brought forward losses 4.6, unabsorbed depreciation 4.9. 22-23 brought forward losses 1.75, unabsorbed depreciation 2.2. The business loss of 4.6 and 1.75 have been deducted while computing the book profits for financial year 21-22 and financial year 22-23 respectively. And if you read below, it says the NCLT has admitted the application under Section 7 of IBC by the financial creditor against the company for initiation of insolvency proceedings on 21st March 2024. So what will be the impact of these brought forward losses?
Then both are allowed, ma'am. Brought forward losses and unabsorbed depreciation.
Why?
Of that case are admitted in the loans.
Yes. But here if you see, it says that the brought forward losses have been deducted and while computing the book profits for 21-22 and 22-23 respectively. So what will happen?
Balance we have to deduct, ma'am.
Balance we need to deduct because these two amounts have been already deducted in the previous year. So again, I will not be able to deduct it. So I will only deduct the unabsorbed depreciation in the current year. Okay. Others also please participate. I need to know your answers as well. The particulars of OCI for the year ended 31st March 2026, rupees in lakh. OCI that may be reclassified to PNL. They have given debit and credit of deferred gain cash flow hedges, deferred cost of hedging, comprehensive income from discontinued operation, exchange difference of foreign operation. What will be the impact of this? Yes. Yes, please. Yes, Saloni. Yes, Dhruvi. Yes. Look at the what we have discussed so far. Yes. And then tell me, read these points and tell me what will be the impact of that.
We'll add back the credit items and the will reduce the debit items.
Okay. Others, what do you think? Yes, Sachi. Yes, Cyril. Yes, Saloni. Samnathan, what do you think? Reclassifiable. Yes, Cyril. Very good. So, this is OCI that may be reclassified to PNL. If it is reclassified to P&L, we will not make any adjustment with respect to this. So this entire amount here, no adjustment required. OCI that may not be reclassified to P&L. This is what we will make the adjustment for. What did I tell you here? No adjustment for items that shall be reclassified to P&L because they will eventually get classified or transferred to P&L. Clear? So here we need to make the adjustment. Now changes in the fair value of equity instruments 10. Will you make adjustment for this?
No, ma'am.
Will not make. Why?
These are notional, right? We discussed something.
Yes. So this is a notional thing, right? So we will not make any adjustment for this because this is completely notional. Okay? Then, so let me write it here. No adjustment. Deferred gains on cash flow hedges, credit 7.25. Yes. To be adjusted, we need to add, yes, Cyril, very good. We need to add this. This is not notional, we will add this. So let's just add this particular thing. Deferred cost of hedging 4.10. Debit. Yes, faster. Yes, students, what will be the effect? To be less, yes. To be adjusted, yes. Very good, Cyril. Very good, Bhumi. So here we will exclude this. We will reduce it, right? Yes? Is this clear, students? Next we have, so here let me just write reduce. Share of OCI of other associates. What about this? Yes. Yes, students, please faster.
No effect, ma'am. OCA is there.
Why no effect? Here, this is not notional. Share of other comprehensive income of other associates, we will add. So this will get added over here. Remeasurement of post-employment benefit obligations.
Add, ma'am.
Yes, we will add this as well. So, whatever are the exclusion which are given, only that we need not consider. So here, there is no exclusion for that. Right? So we will include this as well. Revaluation surplus of assets.
Notional, no. We have not.
This is notional. Yes. So I will use it. No. Clear? The transition amount as on the conversion date stood at 52.50 lakh credit balance, including the capital reserve of 8 lakh and adjustment of 4.5 lakh relating to translation difference in foreign operations. Yes. Yes, faster. One-fifth of 52.5 lakhs, Cyril. Yes. So 52.5 lakhs, will you take or will you exclude 8 lakhs and 4.5 lakh? Let's just look back to what we discussed for the transition amount. Yes. Yes, faster students.
Yes, ma'am. Excluding capital reserve and securities premium.
Yes. So basically, if you look at here, we had the 52.5 lakh, out of which, if you see, 4.5 is the adjustment relating to the foreign operations. We need to exclude it. Here also it's mentioned. We need to exclude the capital reserve and security premium. So we will exclude from 52.5, 8 lakhs and 4.5 lakh, and then we will take the 1. So this will be 1/5 of 52.5 minus 4.5 minus 8. Are we clear, students? Can you calculate the MAT liability for me based on what we have done here? Yes. Please calculate the MAT liability for me. Yes, please, Pastor. Yes. What is the answer coming to? Yes, I'm waiting for your answer. Full question is not appearing. Okay. Okay. Past students. If you're not giving me answer, then I'm moving to the next question. 41.61. Yes. Geeta, is everybody getting the same answer? Yes. 41.61. So the tax liability is normal tax liability is 9.2 lakh. So if you're getting 41.61, then there will be obviously MAT credit. And MAT credit which is there, how will you set off the MAT credit? Yes. Let us see from the module how MAT credits are set it off. So let us look at that portion. So if you look at this, the MAT liability is 4,50,000, tax is 3,95,000. So if you pay tax as per MAT, 55,000 will be considered as MAT credit. In a next year also, if you pay as per MAT 470. So the difference between 470 and 410 is the MAT credit, which is 60,000. So 55 plus 60,000 is what I'll have MAT credit. When in the next year, I pay as per normal tax. So 20,000, which is the extra tax that I'm paying now, because I'm paying as per normal tax, will be given as MAT credit. So I will end up paying the MAT amount only. And the MAT credit can be carried forward for the period of 15 assessment years. Are we clear? Yes or no, students? Is this clear to everyone? Yes? Any questions with respect to MAT? Have you understood both the questions? This is a very, very important area. Yes?
Yes, ma'am. Yes, ma'am.
Everyone? Any questions, any doubt with respect to MAT? Okay? Let's move to the next area then. For the companies which are into the shipping business. Right? The companies which are into the shipping business, they have something called as tonnage tax scheme. They have something called as tonnage tax scheme. Now, what is this tonnage tax scheme? Let's have a look at it. This is an optional scheme for the shipping companies. And this is applicable only to the Indian resident companies. What do we mean by Indian resident companies? Indian company or a foreign company which has a place of effective management in India. Now, here they have certain conditions if they want to go for the tonnage tax. So, a company has to be regarded as a company operating a ship or inland vessel. So, it should have a qualifying ship basically, which can be ship or an inland vessel. It can be entire ship or vessel. It can be part of the ship. It may be operating as on a charter basis. Either it is chartered, like hired a space, a slot, right? That would also be regarded as operating a ship. Right? If it is giving out its ship to somebody else for more than 3 years, then it is not regarded as operator of ship. Right? So basically what they are trying to say, a company should be operating a ship or an inland vessel, even if it is hired. Right? So basically, if I have hired the ship, that is also fine. I'll be said to be operating the ship only. Are we clear? Then it should be a company which is an Indian company or a foreign company having the place of effective management in India, at least one qualifying ship. And the main object is to be in the operation of the ships. What is a qualifying ship? As I said, a ship or an inland vessel having the tonnage of the weight of at least 15 net tonnage and is registered under the Indian Vessels Act. What are not qualifying ships? A sea-going ship or a vessel, if their main purpose is for the provision of goods or services, right? Or fishing vessels. These are not qualifying ships. Factory ships, which are including the vessels in respect of processing the fishing produce. Any kind of leisure craft or pleasure craft, which is for sports or recreation. Ferries, offshore installations, fishing vessel, which is there. These are not qualifying ships. So a company should have a qualifying ship. If it has a qualifying ship and it has the tonnage up to these limits, then the daily tonnage income will be calculated. So up to 1,070 per ton, 1,000 less than 10,000, 700 plus 53 per ton exceeding 1,000 tons. Greater than 10,000 less than 25,000, 5470 plus 42 per ton exceeding 10,000. Greater than 25,000, 11,770 plus 29 per ton exceeding 25,000 ton. And what you have to do is when you take the tonnage, if it is greater than equal to 50, you have to round off to the next number, next 100. If it's less than 50, you have to round it off to the previous 100. Once you do the tonnage tax scheme, or once you go into the tonnage tax scheme, right, this is the entire scheme which is there. This has to be considered as a distinct and separate business. The profits should be computed separately from the other businesses. Right? And in that respect, when you compute the income, you will compute considering these limits itself. And this has to be calculated on the basis of the number of days for which the ship is there, which is particularly open. Are we clear? This is a daily tonnage income. This is the daily tonnage income. Okay? And you will then not get any other deduction or set off of losses. You will not get any deduction or set off of losses. And here, the incidental income as well as the core activities will be considered. However, if the incidental activities are more than 25% of the turnover from core activity, then incidental income is considered as separate income and not part of the tonnage tax scheme. What are the core income? Which are basically arising from shipping contracts, contract of freight, right? Onboard, offshore, onshore activities of passengers, leasing out the ship, right? So all those core activities are considered for the purposes of tonnage tax. Are we clear? Any questions, any doubt? Yes? Yes or no, students? Is this clear?
Yes, yes, ma'am.
Okay. So this is a very small scheme which you should be knowing about in case the question is asked. Then we have the alternate minimum taxes. Now the alternate minimum taxes is just like your MAT. It is applicable to any other person other than company who has claimed the deduction under Chapter 6A, Heading C. What is this Chapter 6A, Heading C? Yes?
ATIA, ATIAC and all.
Right. ATIA, ATIB, ATIC, all the deductions in relation to the income. Yes. So if any person has claimed these deductions in relation to the income, so that person is also required to pay the AMT. Whether you claim LIC, medical, that will also be considered.
No, ma'am.
No, right? Because that is not deduction in relation to the income. Yes, Cyril, very good. So, if you now have a look at it, it says it has claimed the deduction under Chapter 6, say heading C, or claimed the deduction under 35 AD, or claimed the deduction under 10 AA. What is 35 AD?
Specified income.
Specified business deduction. Right? So, if you look at it, if you claim these income-based deduction, you will be subject to AMT if your adjusted total income is more than 20 lakh rupees. To whom this is not applicable, AMT is not applicable. AMT is not applicable for individual HUF, AOP, BOI, not opting out of 115 BAC, or the cooperative societies opting for 115 BAD or BA. Are we clear? How will you calculate your adjusted total income? Your total income, add chapter 6A deductions, whatever you have claimed, excluding the ATP, add deduction under 10AA, add deduction under 35AD minus depreciation under 32. So here your AMT rate is 18.5%. For IFSC, it is 9%. For cooperative society, it is 15%. So if your normal tax is less than 18.5% of adjusted total income, then AMT will be applicable. Here also, just like MAT, you will get the AMT credit as well. Are we clear? Yes or no?
Yes, ma'am.
So this is very similar to MAT, but here in the MAT, what you do is you start with the book profit. Here what you will start with is
Adjusted total turnover.
no, you will start with your total income only, but then you will consider your adjusted total income basis by adding all these deductions which are there. Are we clear?
Yes, ma'am.
Yes. So again, in the exam, if a question is asked and it doesn't say that you ignore the AMT liability, then you need to also consider the AMT liability also. Okay? Yes. So if you want, we can take up one question right now with respect to AMT before we close the session. That will help you understanding how the AMT liability is calculated. So let us solve a question from PGVP. Just give me a minute. Yes. So Mr. A commenced the operations of setting up a warehousing facility for storage of food grains, sugar, and edible oil. Right? And he has incurred the expenditure of 80, 60, 50 on purchase of land and building during the period Jan 25 to March 25 for the above businesses and capitalized the same in the books of accounts. The cost of the land included in the above figure is 50, 40 and 30. During the previous year, he incurred the capex of 20, 15 and 10 lakh respectively for extension or reconstruction. The profits from the business of setting up the warehouse for storage of food grain is given as 16, 14, 31 for three businesses. Assuming respect of expenditure incurred, the payments are made by account paid check. Compute the income under that PGBP for the 26-27 and the loss to be carried forward, assuming A is exercising the option of shifting out of 115 BAC 1A and has fulfilled all the conditions for 35 AD and wants to claim the deduction under 35 AD. So first we'll calculate as per the normal tax provision what will be the business profit. So which all businesses are eligible for 35 AD? Yes.
Food grains and sugar.
Food grains and sugar, right? These are the eligible businesses for the 35D. What about the edible oil?
It is normal, not 35 AD.
Normal, yes. So how will you calculate the deduction for 35D?
All the revenue and capital expenditure except land.
Yes. That's good. Right? So basically, if you look at it, you will start with the profits, right? What are my profit for food grain and sugar? 16 and 14 lakh. Less deduction under 35D will be all capital expenditure excluding the land. Even the capital expenditure incurred prior to the commencement of business will be taken because these are capitalized in the books of accounts as on 1/4/25. So I'll exclude the cost of the land. Then capital expenditure incurred during the previous year, I will also consider. So this is my capex, right? 100% of capex I'll get as deduction under 35A. Now, in the first scenario, I have a loss. In the second scenario also, I get a loss, right? Can I set off this loss against a normal business income from the oil?
No.
No, right? Why we can't?
A specified business can be set off against a specified business only.
Correct. So for the normal business, I will have 31 minus, I will have the depreciation on capex, which is 50 minus land cost plus current year expenditure. So 28 will be my normal business income. Now I want you to calculate the AMT for me in respect of these three profits that you have. What will be your starting point now?
Total income.
What is the total income?
A normal provision we have done, ma'am.
Sorry?
As per this normal provision we have done, no?
Yes. But what will be my total income? See. So, I will start with this profit, which is my total income will be 28 lakhs itself, right? This is my total income. I don't set off the losses. This will be my total income only. This is my total income. Yes or no? 28 lakh is the total income.
Yes.
I don't have any other income. Correct? So 28 lakh is my total income. Then what does this say? Provision for adjusted total income. Add the deduction under 35. What is the deduction that you have claimed under 35 here?
₹85 lakhs.
85 lakh. I will add back that 85 lakh. Minus depreciation under 32. So when I add back this 85, I'm disallowing the deduction for the capital expenditure under 35D. But the assessee, if he is not opting for 35D, he would still be eligible to claim the depreciation under 32, isn't it? Because this is a capital expenditure, right? So the depreciation will still be given to him. Even if he doesn't get 35D, he should still get the depreciation. That's what you are even doing for oil, isn't it? So I will reduce the depreciation, which is 10% because the asset was building. Yes or no? So on 85 lakh, my depreciation is 8.5 lakh. So what I will add is 76.5 lakh. So what will be my adjusted total income? 104.5. AMT is 18.5%. Surcharge will be there because the total income exceeds 1 CR. So what is the surcharge for individual?
Above 50 lakhs, 10%, up to 1 crore, above 1 crore, 15%, up to 2 crore, and above 2 crore, it is 25%.
So it will be 15%, right? So my total tax will come to 23.12167. My normal tax was 6,78,600. So therefore the AMT applies. Now if the question tells you do not ignore 115 BAC, then here also you will make a comparison between 115 BAC and normal tax provision. In 115 BAC, what I will do is I will not claim 35 AD, but what I will claim is depreciation. Yes or no? Yes or no?
Yes, ma'am.
So 28 lakh is profit from oil. From food grain and sugar, it is 30 lakh. I will claim depreciation 8.5 lakh and I will not claim 35 AD. My total income comes to 49.5 lakh. My total tax comes to 10 lakh 3,000. So what is better? Should I go for normal tax or 115 BAC?
115 BAC.
Yes. And when you go for 115 BAC, you don't have the AMT getting applicable. Yes or no?
Yes, ma'am.
Is this clear? Any questions? Any doubt? Yes? Okay. The last thing before we close for today is the taxation of the partnership firm. What is the tax rate for partnership firm?
30%.
30%. What is the surcharge?
1 crore, 12%.
Greater than 1 crore total income, 12% and cess. For partnership firm, what are the conditions for claiming the remuneration deduction to the partners?
We should be working partner, and it is in the deed, it is mentioned.
Yes, yes, sir. It should be paid to a working partner. Can a company be a working partner? Working partner means an individual. A company cannot be a working partner. It should be paid to a working partner. The remuneration should be authorized by the partnership deed. The remuneration should not relate to the period prior to the partnership deed. And it should not exceed the specified limit. What is the limit for the remuneration? Yes, what is the limit for remuneration?
Up to 6 lakhs, 90%, and above it, 60%.
First 6 lakh or in the case of loss. 3 lakh or 90% of book profit, whichever is higher. On the balance book profit, 60%. Now, what is book profit over here?
In net profit, we have to add back the remuneration.
Yes. So, net profit as per the head of PGBP, before setting off any losses, you can reduce the unabsorbed depreciation, and this is you will consider as the book profit. You don't need to reduce any brought forward losses or the remuneration paid to partners. Okay, you will add back the remuneration. In the hands of the partner, what will be the tax treatment for the remuneration?
Exempt, ma'am, under 10 to A.
It is taxable, right? It is not exempt. The remuneration
Share
is
of
taxable
profit.
under
Yes.
28.5.
Yes,
If it
share.
is disallowed to the firm as an expense, then it will not be taxed in the hands of partner. The profit share is exempt. The remuneration is taxable. Okay? Then comes interest on capital. What happens to the interest on capital?
Up to 12% it is allowed.
Up to 12%. It should be again authorized by the partnership deed. It should not pertain to period prior to partnership deed, and the rate of interest should be less than 12% per annum on all the balances of partner, capital, current, loan account, everything. In the hands of partner, again, this is taxable under 28(5). When you pay the remuneration and interest to the partner, you have to also deduct the TDS under 194(t) at the rate of 10% for the interest and remuneration more than 20,000. Now, what if the partner is in a representative capacity? For example, if the partnership firm is XYZ and ABC HUF is the partner, but the Karta of the HUF, Mr. X, represents the ABC HUF in the partnership firm. Now, if any interest is paid on capital or loan to Mr. X in the representative capacity of the HUF, will it be subject to 40B? Yes, will it be subject to 40B?
Yes, ma'am.
Yes, right, because the capital is contributed by the HUF. It is given to Karta in the representative capacity. So this will be subject to 40B. If Karta gives the loan in his personal capacity to the firm and he takes the interest or charges the interest, so Karta is not the partner in a partnership firm. It is the HUF which was partner. So that interest will not be subject to 40B because X has not given the loan as a partner. Are we clear? Or if, let's say, X is a partner in the firm and he has not given any loan, but his wife has given the loan to the firm. But the interest is paid by the firm to X instead of its wife. Will it be subject to 40B?
No, ma'am.
No, right? Because the loan is given not by the partner, it is given by the wife of partner. Now, the interest is paid on behalf of the wife to the partner. It is paid to the partner on behalf of some other person. So, this will not be subject to 40. Are we clear? Yes?
Yes, ma'am.
Last thing, in the case of loss, in case of a partnership firm, if there is change in the constitution of the firm, either on account of retirement of partner or on the death of a partner, then the share of the retiring or deceased partner shall lapse. This applies only to business loss and not to unabsorbed depreciation. This doesn't apply on account of the change in the constitution, on account of change in the profit sharing ratio of the partners, or on admission of new partner. This only applies on the retirement or death of partner. So let's say if the ABC firm is there, C dies, there was a loss of 3 lakh, the PSR was 1:1:1, then the 1 lakh rupees share of C will lapse. It can only carry forward 2 lakh. But the UAD, unabsorbed depreciation, can be carried forward. There, section 78 is not applicable. Are we clear, students? Is there any question, any doubt with respect to the partnership firm?
Clear, ma'am.
Clear? Everybody clear? So see, students, now what I want you to do is, in the next class, we'll be left with AOP, BOI, HUF, right? And taxation of the cooperative society. So that we will, take care in the next class. But what I want you to do is, I want you to solve the questions also at home and revise everything that we have done today. And if you would be able to revise everything, in the next class, we will be focusing the substantial portion of the class on solving these sums. so that you get a hang of how the questions are asked practically in the exam. So I want you to go through all the provisions in detail once again. So in the next class, we will be focusing on solving many questions on the partnership, on the full-fledged adjustments, right? So that you have the knowledge about how to present in the examination, which is very, very, very important. But that can only be done if you participate, if you have gone through the topic in entirety. So whatever we have done so far, I want you to please complete it before we meet in the next class. Will you be able to do that? Yes?
Yes, ma'am.
Everyone, please revise it because then it will be a better lecture for you. You will be able to understand everything. You will be able to ask the doubts. You will be able to clear your questions. You will be able to understand where you are making the mistakes, what concepts you have not studied. Otherwise, this lecture will not be a revision lecture for you. You will, not be because, usually we have 3 to 4 classes for assessment of various entities. Since this is a revision class, it's going to end in 2 lectures. So that is the purpose that we are going fast because it's a revision class. But you have to revise and come to sit and understand and appreciate this class. Okay? So we'll stop here for today. We'll not start any new topic because we're left with only 5 minutes. So in the next class, we will be solving many questions. Okay, if you have any questions, we can discuss. Otherwise, we can close the session.
Means, ma'am, can you give us the answer of that OCI, this Indians compliance question is there, no?
Yeah.
Means full-fledged, means how to solve that question. Can you give us
See,
the
that
answer?
is a past exam question only. You will get that. In case you want, I will send you the answer. I'll upload the answer like a full-fledged proper answer for that as well. I will upload it. No problem. Any other question?
No, ma'am. And that three means in one question we have done this 115 BAA and all this three are coming. No, that answer is not completed in exam, ma'am. How much practice I have to do?
See, that see, for that kind of question, you will have to, learn to basically understand the provisions. Once you have done that, your speed will pick up. And once you have like a lot of practice, your speed will pick up. So what you need to do is the way we, made the 3 tables over here in the exam also, you have to follow the same approach. Make the 3 tables simultaneously on the 3 pages and start solving it and putting the figures over there. So in such kind of questions, the presentation should be less focused. Solving the answer will be more focused because it has to be completed in a record time.
Ma'am, can we get the solution of that question
I
so
will
that we
upload it. I will upload it.
sure.
Okay. So thank you so much, students. Yes. Anybody have question?
Ma'am, this shipping companies is there in non-resident also. What is the difference between this ship and that 44BB something section is there?
This is for the resident companies and that's for the non-resident companies.
That 172 section is there in, it is
It's for
different.
non-resident. This is for resident. The tonnage tax is for the resident companies. Any other question?
No, ma'am, thank you.
Okay.
Thank you so much.
Okay. Okay, so let's close the session. Thank you so much. Yes.